Hi, I'm Morgan Harding, a portfolio manager at AllianceBernstein. Our topic today is generating income and capital appreciation amid inflation risks. Inflation has come up for the first time really in decades, and it threatens the returns especially for income-oriented investors because they tend to rely heavily on government bond exposure, which tend to do poorly during periods of inflation. The good news is that if you take a multi-asset approach to generating income, you can get exposure to equities and credit, which have tended to fare better during many periods of inflation historically. But those do bring more volatility, which needs to be managed in an integrated manner. So, what are the keys to success for making multi-asset income portfolios resilient to inflation? What are some of the critical signals for managing through inflation risks? And what other headwinds and tailwinds beyond inflation should income-oriented investors consider today? Inflation has been happily infrequent in the United States over the last century. I'm showing you here 100 years of history, and I've shaded the 8 episodes of inflation over 5% that we've experienced. Only 2 of them have been in the last 30 years, and that's generally been a very favorable setting for investors, which is why investors are worried about this current period of higher inflation. So I'm going to spend the next 20 minutes or so going over the history of these inflation episodes and what the experience has been like for income-oriented investors. And we'll also talk about the current context and what else investors should have in mind as they approach income generation and capital appreciation. Over that 100-year history, investment returns for income-oriented investors have been very strong. So I'm showing here the different components that you typically find in an income-oriented portfolio, starting with the S&P on top, which had the strongest returns over that period, an average of 9%, as you see on the left display, and moving down from there to BBB corporates, credit, treasuries, and cash. All of these returns are in excess of inflation, so real returns. And the blended portfolio benchmark, or average on the bottom, assumes you had 40% in the S&P, 40% in BBB corporates, and 20% in treasuries. So a 6% average inflation-adjusted return over 100 years has been very strong. Now, of course, the challenge is that if you look to the periods of high inflation in the middle, so segmenting that 100 years just to the times when inflation was above average, the returns were uniformly lower. The blended average would have been just 2% for an income-oriented investor. On the other hand, on the far right, you see that average returns during periods of low inflation were even higher than usual, averaging 8%. The rank order of what did best and worst didn't change, but returns have clearly been on average higher during periods of low inflation than during periods of high inflation. It's not just that returns are more challenged during periods of high inflation, but risk tends to be elevated as well. What I'm showing here is the correlation between stocks and bonds. So when correlation's lower, that means stocks and bonds tend to move less in the same direction and more in opposite directions, which really helps to smooth the ride for a diversified portfolio. And what you see is over the most recent couple of decades, that correlation has been negative, meaning on a day-to-day basis, stocks and bonds move in opposite directions. Whereas if you go back in time to the last century when inflation was higher, that correlation tended to be positive on average. And what that means for risk in an overall portfolio is you get less of a diversification benefit, and the overall portfolio risks tends to be more elevated. Let's turn back to returns in that long-term history. I'm showing here on the left the average return during periods of above average inflation. And as a reminder, that's when returns tended to be lower. But if you segment that into 2 parts, the times when inflation is above average and rising, or above average and falling, you see quite a different picture. So in the middle, what I'm showing you is the returns of these different assets when inflation is high and it's continuing to rise. This tends to be the worst regime for income-oriented investors. You see lower returns across the board with a blended average of -2% in real terms. You also see that the rank order of what does best and worst changes a bit. Credit actually still ekes out a positive return when inflation is high and rising. Treasuries, on the other hand, fall to the bottom. They earn an even more negative return when inflation is high and rising. So what's happening there? Well, with credit, there's a benefit to the borrower from inflation in that their future obligations are paid with inflated dollars. It's easier for them to pay back their debt, and their revenues tend to be rising with inflation too. So credit risk actually goes down. So you can see a positive return from credit when inflation is high and rising. Treasuries, on the other hand, tend to fare even worse because to the bondholder, those future coupons and that future principal is worth even less after adjusting for the erosion of inflation. So we have to take into account not only the expected returns and how they change, but also the rank order of what does best and worst as we navigate periods of high inflation. Now, it's interesting, though, when inflation's high but it starts to fall, which is what you see on the far right, that tends to be a really good investment environment for just about everything. You see the average returns across the board are higher, and the blended average of about 7% is very strong. Why is that? Well, the discount rate for those future cash flows across all assets starts to come down, and that generates capital appreciation across just about every asset class, which tends to be very strong. So even in these periods of high inflation, you can still see high returns, and navigating through inflation when it's rising or falling can be very helpful. Navigating through these periods of higher inflation requires both a fundamental and a quantitative perspective, forecasting whether you anticipate inflation is going to be rising or falling, but also looking at quantitative signals from the market itself to guide you into or away from different parts of the market. And what I'm showing here is the encouraging news that during these periods on the far right, when inflation is high and falling, when the return to being in riskier assets can be very high, you have a much broader range of quantitative signals that tend to be effective. So I'm showing 4 different categories of quantitative signals here: the equity trend, credit conditions, the inflation trend, the rate trend. All of them can be quite effective in guiding you through these periods of high and falling inflation when the reward to getting it right can be especially strong. So where is inflation headed today? Our expectation is it's likely to trend down over the coming quarters. Over the short term, there are some pressures that are likely to ease. First of all, you have what we call a negative fiscal impulse, meaning that the growth in government spending is coming down. Second, the Fed is tightening monetary policy with the explicit intention of reducing inflation. And third, you have inventories that are less stretched today than they were some 6 months ago. That takes some of the pressure off too in the near term. And then longer term, there are also some disinflationary trends. One, of course, would be the technology and automation will continue to keep costs down for any number of goods. Another could be that investors and individuals just spend less because they expect to earn less on their investments going forward, and that takes some pressure off on the demand side. Now, there are also some inflationary pressures that make it less certain that inflation will trend down or just how quickly inflation will trend down. Some of the same pressures that caused inflation to go up in recent months are likely to stay with us for a while. Some of the upward pressures on energy and food costs related to the war in Ukraine will persist. And some of the supply chain problems related to COVID will still be with us for some time. There may be longer-term inflationary pressures which remain in place too, or that come onto the radar. Things like deglobalization. To the extent that globalization brought inflation down, if we start reshoring and producing more in our home countries, that could put pressure on prices upward again. You also might see more active fiscal policy, which could keep upward pressure on inflation. Carbon reduction could also, in the near term or even the intermediate term, keep upward pressure on fuels. So the outlook for inflation isn't totally certain, but we do expect it to trend down as we weigh these pros and cons for inflationary pressures. Inflation certainly matters and is central for income-oriented investors as a risk, but it's not the only driver of risk and return. Growth trends are often equally as important as inflation trends as we look at investment returns over time. What I'm showing here on this display is the intersection between inflation and growth. So on the left-hand side of the display, these are average returns during periods when inflation was declining or decelerating. And of course, the reverse on the right-hand side when inflation is accelerating. I've added the additional dimension of growth. So above the horizontal line, growth is accelerating, and the reverse is true below the horizontal line. So our expectation is that in the coming quarters, we're going to be on the left side of this display, meaning inflation will be decelerating. And to the extent that that occurs and growth also accelerates, well, that's nirvana for investors because you have strong equity returns and credit returns in that environment. But of course, it's not totally certain. If we're right about being on the left side and inflation is decelerating, but if growth is also decelerating, well, then we're on the lower left, and that's not so great for income-oriented investors. You'll have some fixed income and maybe, if you're lucky, some REIT exposure, and that should hold up better, but the equity and credit returns tend to be worse during those environments. So we need to keep an eye on both inflation and growth as we anticipate what kind of regime we're in to make investment decisions. As we pull back the lens beyond growth and inflation and think about equities as an asset class going forward, there are a number of other considerations that are also important. One would be valuation. Now I'm showing the 10-year average valuation plotted in the horizontal line for global equities as measured by the PE ratio. Some people might say that it looks in line with average. Others might say, well, this doesn't represent the long-term cyclically adjusted average. You should use a Shiller ratio or something like that, which would make equities look more expensive. Or you'd say, well, you need to adjust for the low real interest rates. That would make equities seem cheaper. Those are both important considerations, but there's some others as well, like sentiment. In recent years, there's been this narrative around the idea that there's no alternative to equities. They're going to keep going up because interest rates are so low, investors have nowhere else to go. I'd say in 2022, that narrative has started to break down as you've seen outflows from equity funds. Now, the fundamentals of equities still look pretty strong. Companies are generating high profitability, good cash flows, and that's likely to continue for the foreseeable future. But there could start to be some populist pressures on profit margins or the ability of companies to buy back their shares, and that might be a dampener for equity market returns going forward. Longer term, there's some sort of very long-term growth considerations as well that might be relevant for equity investors. Something like the energy transition. To the extent that new technologies are invented that allow us to wean ourselves off of carbon, that could be very good for profitability and economic growth going forward. On the other hand, the Western world is aging, and that's going to take away from demand over time, and that might impair profitability of publicly listed companies. For credit, there are also broader tailwinds and headwinds. And here too, I'm showing a measure of valuation, the credit spread. And it also, like with equities, looks to be about average. Now, you might say this is actually very compelling because defaults or the real underlying risk in credit have been below average. So getting an average return is especially good after you adjust for that. On the other hand, some investors would point out, well, these spreads are asymmetric, meaning they can only go down so much, but they can go up a lot more, and you should be compensated for that. So it seems fairly valued now. There are also sentiment considerations in credit. As we go into a period of lower growth, investors might say, well, I'm going to be even more interested in the safety and income of credit investments over other parts of the capital markets. On the other hand, as central banks pull back from government bonds and also to some extent from credit, that takes out an important buyer, which could affect sentiment as well. The fundamentals of credit still look good. Cash flows are strong. Interest coverage is good. Many companies have termed out their maturities over the coming years. But to the extent that growth really is decelerating and credit spreads remain elevated, refinancing will become a bit more expensive at the margin. And finally, on growth, credit investors don't require the kind of really strong growth that boosts equity returns. So just good growth can be good for credit investors. But to the extent we do move into a recession near term, which is not our base case, that would tend to be negative for credit investors. So now let's look at the tailwinds and headwinds for government bond risk or duration. Here, a measure of valuation, the 10-year Treasury yield, is starting to look attractive relative to the 10-year history, above average. Now, that may in fact be attractive, or it might need to adjust even further upward if inflation remains elevated. We'll see. From a sentiment perspective, I think positioning is quite light in government bonds this year. They've done very poorly through much of the first half of the year, which means there have been a lot of sellers. Positioning is cleaner. On the other hand, it could get even lighter, particularly as central banks stop purchasing government bonds as quickly. So there's a controversy there. The fundamentals of government bonds still look good. Longer-term inflation expectations continue to be well anchored, and as I showed you before in the correlation display, government bonds still serve their purpose of acting as a ballast to equity risk and helping diversification. The growth picture is also interesting for government bonds because it's a bit opposite of what you want from equities, which is to say that if growth gets less certain, that tends to be good for government bonds because investors will tend to prefer the safety of that duration risk. So generally speaking, a lot of the return in an investment portfolio will come from exposure to stocks, bonds, and credit. There are scenarios, though, such as the so-called stagflation scenario that can be quite negative for all three of them. And you want to have some ability to generate positive returns in that scenario to offset the negative returns from market exposure that you might experience. And a nice thing about being an active manager is that you can lean into certain factors or sectors and generate positive returns even when the overall investment environment would seem quite negative. So I'm showing you here a range of returns during episodes of stagflation, or when inflation is rising and growth is falling. On the left, we have some equity factors. We have equity momentum and the low vol equity factors. This isn't the equity market as a whole, but how individual stocks are doing within the equity market. So a stock picker can outperform in a scenario like that if they lean into these types of characteristics. And likewise, as you move to the middle for FX or currency markets, carry and value strategies have tended to do well during these episodes of stagflation. So if you manage currency actively, that can be another source of positive return. And finally, in fixed income, if managed actively, carry and value characteristics have also tended to be rewarded during these episodes of stagflation. So taking an active approach not only in terms of asset allocation, but also security selection within the equity markets, within fixed income, and within currency can really be a helpful addition to overall portfolio performance. So tying this all together, I hope I've helped you see that an active all-market approach to income investing can really be beneficial through a period of inflation. Strategic allocations to equity and credit can be more resilient in the face of inflation surprises. Things like real estate can also do well as an inflation hedge. And what you might call systematic macro, or those factors and sector tilts, can also provide uncorrelated return, which can be a nice ballast. Tactical allocation can be very successful. I showed you how when you're in high inflation and it's falling, that's a time to take more risk, and that fundamental and quantitative signals can help guide you through those periods. So when you pull it all together, a multi-asset income strategy that has breadth across asset classes and strategies and can tactically allocate can be very resilient through periods of inflation.
投资一定有风险，基金投资有赚有赔，申购前应详阅投资人须知或公开说明书。